Welcome to the Hickory Hound, providing economic, cultural, and political insight, serving Hickory and Western North Carolina. The 2026 economic reality is simply the 2012 recovery in disguise. Headline numbers look great on paper, but underneath, the machinery has evolved to keep ordinary people losing ground in real life. Growth by itself is not broad-based recovery. This slide exposes the split inside the 2012 official ledger versus ground reality. On the left, the official narrative celebrated a slow, steady recovery as U3 unemployment dropped to 8.2%. On the right, the structural breakdown tells the real story. 88 million workers left invisible, real unemployment hitting 22%, and a 40% collapse in family net worth. The raw truth was masked by a statistical illusion. The 2012 economic reality check revealed 100 million Americans without jobs, and the, quote, real unemployment rate at 22%. Banking issues included a $4 billion trading loss at JP Morgan and hidden inflation via, quote, shrinkflation. The 2012 economic fragility showed a great disconnect. Systemic financial risk included a $230 trillion derivatives bubble and high leverage ratios for major banks. Main Street erosion was marked by a 39% drop in median net worth and a transition to a part-time society. This slide highlights the extreme inequality of the 2012 rebound mechanics. The top graphic shows a stark concentration of wealth. A massive 93% of real income growth was captured solely by the top 1%. Below, the lever visualizes a wildly unstable financial system. Unregulated banks leveraged a $230 trillion derivatives casino on a tiny sliver of risk-based capital. Growth belonged entirely to the plutocracy. This slide exposes the money illusion iceberg of 2012. Above water, rising retail sales mask hidden danger. Below, rampant inflation squeezes 46 million citizens on food stamps via rising beef prices and aggressive shrinkflation package cuts. Mechanically, a terminal $2.52 debt-to-GDP ratio keeps propping up a debt-fueled hallucination. Wall Street sees retail metrics. Main Street lives survival realities. This slide tracks the evolution of labor from 2012 to 2026. First, offshoring saw multinationals expand overseas 3 times faster than at home. Second, a demographic void emerged as independent operations folded and retiring boomers left a severe human capital deficit. Third, automation replaced returning capital with tech infrastructure requiring hyper-specific certifications. We traded an offshoring crisis for an automated squeeze. 14 years apart, the same mechanical failures grind down the household margin. First, data disconnect. Record indices mask stagnant GDP and frozen margins. Second, an energy logistics tax. Middle East choke points lock in a $4.15 gas floor. Third, administrative gridlock. Political impasses freeze public permitting, stalling private capital. The structural bottlenecks never left the tracks. The machinery of extraction didn't slow down over 14 years. Its gears simply evolved to penalize human labor. First, labor dynamics shifted from a massive 2012 payroll deficit to a tight 2026 market restricted by a severe skills chasm. Second, the housing paradigm inverted from crashing foreclosure values to an active inflation crisis, with outside tech crews driving instant 15% rent spikes. Third, monetary policy transitioned from a $3 trillion liquidity injection to a defensive policy trap, locking in rigid borrowing costs. We traded an offshoring crisis for an automated squeeze. The funnel illustrates a brutal efficiency, pouring billions in tech capital into an automated engine that systematically strips out human hours. The friction forces regional education to pivot into hyper-specific certifications to feed narrow tech demands. The result pins the national labor share to an all-time 54.1% historic floor. Capital extracts high margins. Human labor shrinks. This slide visualizes the K-shaped destiny facing our regional economy. Above, corporate reality scales vertically through high-density tech infrastructure, generating rich property tax revenues. Below, household reality slopes downward as legacy workers face localized inflation and a permanent logistics tax. Top-line growth masks an economy structurally locked out from providing a middle-class paycheck. This text-driven slide brings the macro matrix directly home to the region, the local reality for Hickory and the foothills. Top-line expansions, infrastructure capital, and surging tax bases mean nothing if they leave local workers underpaid, residents priced out, and local utilities strained. Without targeted policy protections, modern industrial growth is simply extraction with better branding. This matrix clarifies the fork in regional policy, the extraction versus development filter. To achieve genuine development, 3 thresholds must be met. Utility upgrades must be 100% funded by corporate capital, workforce wages must match stable local household needs, and neighborhood integrity must be insulated against displacement. Any alternative redirecting these burdens back to residents is purely economic extraction. This infographic delivers a complete visual summary titled The Recovery Illusion. On the left, we map the 2012 blueprint for extraction, a 40% family wealth collapse, a $230 trillion bank casino, and 93% of growth captured entirely by the top 1%. On the right, we expose the 2026 automated squeeze, labor share hitting an all-time 54.1% floor, localized 15% rent spikes, and a higher-for-longer borrowing trap. It visually proves that we merely traded an offshoring crisis for an automated squeeze. This infographic delivers a complete visual comparison of our structural matrix. On the left, we map the 2012-era deficits, massive job shortages, crashing foreclosure values, and an aggressive $3 trillion central bank balance sheet expansion. On the right, we show the 2026 automated supercycle, tight labor markets restricted by a severe skills chasm, instant 15% rent spikes, and a defensive higher-for-longer borrowing trap. We merely traded an offshoring crisis for an automated squeeze. To shift the trajectory, we need 3 specific policy mandates. First, resolve administrative backlogs to unfreeze regulatory desks and allow private capital to circulate. Second, enforce corporate infrastructure accountability by requiring tech corporations to pay for local grid and utility upgrades. This slide delivers our clear closing imperative, measuring what matters. We were told in 2012 that recovery had arrived, but for millions, it never did. By 2026, the warning is clear. An economy can easily grow on paper while ordinary people lose ground in real life. True recovery must be measured where people actually live. Follow the Hound on these platforms and we will keep moving forward.